As I speak to you right now, shares of Aimei Health Technology Co. Ltd., trading under the ticker symbol AFJK, are sitting at exactly $40.34. If you are looking at your screen, you are seeing a sea of red that might make even the most seasoned trader blink, with the stock down a staggering $48.16, or 54.42%, just in today's intraday session. This is not a typo, and it is certainly not a glitch in your brokerage platform. What we are witnessing is the violent, gravity-defying, and subsequent earth-shattering reality of the modern financial markets in their rawest form. Just 24 hours ago, this stock was virtually unknown to the average retail investor, languishing in the single digits before it exploded in a move that defied all conventional logic, soaring over 1,000% to touch highs near $98. Today, gravity has come calling, and the retracement is as brutal as the ascent was euphoric. Expectation in the market is a powerful drug. The expectation here, fueled by frantic message board chatter and momentum algorithms, was that Aimei Health Technology had discovered the holy grail of valuation, perhaps linked to its extended merger talks or a sudden fundamental shift that justified a tenfold increase in value in a single trading session. Investors, particularly those new to the game who might be used to the steady, predictable grind of Apple stock or the robust, liquidity-rich environment of Nvidia stock, likely looked at that green candle yesterday and expected a continuation. They expected that a move of that magnitude had to be backed by something tangible, something solid, something that would keep the price elevated. The reality, however, is far more complex and, frankly, far more dangerous. The reality is that this price action has almost nothing to do with the fundamental business of Aimei Health and everything to do with market structure, share float, and the mechanics of a specialized financial vehicle known as a Special Purpose Acquisition Company, or SPAC. To understand why a stock goes from $8 to $98 and back to $40 in the span of 48 hours, we have to look under the hood. Aimei Health Technology is a blank check company. Its sole purpose is to merge with a private company to take it public. Recently, shareholders voted to extend the deadline for this merger, specifically targeting a combination with United Hydrogen Group. But here's the critical piece of the puzzle that the headline grabbers missed. When these SPAC deadlines are extended, original shareholders are often given the right to redeem their shares for cash. This redemption process removes those shares from the public market, effectively shrinking the supply. In the case of AFJK, recent filings suggest a massive number of shares were redeemed, leaving an incredibly small public float, potentially under 1 million freely trading shares. When you have a float that small, the laws of supply and demand become distorted. It does not take billions of dollars of institutional capital from Fidelity Wealth Management or huge buy orders through Interactive Brokers trading platforms to move the price. It only takes a spark. Yesterday, that spark lit a fire. A relatively small amount of buying pressure, perhaps from retail traders or high-frequency algorithms, hit a market where there were simply no sellers. When there are no shares to buy, the price ticks up, and up, and up. It creates a vacuum effect. Traders using the Robinhood app or checking their SoFi active investing accounts see the percentage gain leaderboard, see AFJK up 200%, and the fear of missing out kicks in. They buy at market, pushing the price to 300%, then 500%. It becomes a self-fulfilling prophecy of momentum. But today, we are seeing the other side of that coin. The reality is that the company's intrinsic value did not change overnight. The hydrogen merger deal, while promising, did not suddenly become 10 times more valuable on a Tuesday than it was on a Monday. This brings us to the harsh lesson of liquidity. If you are sitting on losses today, it is likely because the expectation of infinite squeeze collided with the reality of profit-taking. When a stock rises this fast on low volume, the air beneath it is thin. There is no support structure, no months of price consolidation where buyers and sellers agreed on value. So when the selling starts, as it did this morning, the price collapses through the floor because there are no buyers willing to step in until it hits significantly lower levels. This is the difference between investing in a blue-chip giant and a low-float SPAC. With Tesla stock, you have millions of shares changing hands every hour, creating a thick order book. With AFJK, the order book is paper thin. You might see a bid at $40 and the next bid at $38. That gap represents extreme risk. Let's take a step back and consider how this fits into your broader financial life. If you are using Schwab Intelligent Portfolios or managing your own funds through a Fidelity brokerage account, you are constantly told to diversify and manage risk. Yet the allure of these lotto ticket moves is undeniable. It's the reason why online investing has exploded in popularity. Platforms like Robinhood Crypto and SoFi Invest have democratized access, allowing anyone to jump into the fray. But access does not equal insight. The movement we are seeing in AFJK is a prime example of why understanding market mechanics is just as important as understanding a balance sheet. The smart friend approach here isn't to tell you not to trade it, but to tell you that you aren't trading a company right now. You are trading a supply imbalance. You are playing a game of musical chairs where the music is speeding up, and the number of chairs, the willing buyers at these elevated levels, is rapidly decreasing. Now let's talk about the company itself, because amidst this chaos, there is an actual business entity here. Aimei Health Technology is a Cayman Islands exempted company. As I mentioned, it is a SPAC. These vehicles raise money from investors with the promise of finding a private company to acquire. The target in their sights, United Hydrogen Group, operates in a sector that is garnering massive global attention. Hydrogen energy is often touted as a clean alternative to fossil fuels, a key component of the future green economy. In theory, a merger with a hydrogen player could be a significant catalyst. If the deal goes through and the combined entity can prove its technology and business model, there is a legitimate long-term investment thesis to be made. However, we must separate the long-term potential of hydrogen energy from the short-term technical dislocation of the stock price. The price you are paying today at $40 is vastly higher than the $10 or so that the SPAC units originally sold for. You are paying a massive premium for the possibility of this merger closing and the possibility that the market will value the new company highly. When you look at the financials of a SPAC before the merger, you are essentially looking at a trust account holding U.S. Treasuries and a management team's expense report. There is no revenue from operations yet, no product sales to analyze, no profit margins to critique. This makes valuation incredibly difficult for the average person doing self-investing. You can't look at a price-to-earnings ratio because there are no earnings. You can't look at price to sales because there are no sales. You are betting entirely on the management team's ability to close the deal and the market's appetite for the target company. This is why the stock sat dormant for so long. The expectation was that it was just another SPAC searching for a deal. The reality shift happened not because the deal closed, but because the tradable shares disappeared due to redemptions. It is interesting to compare this to how you might handle a more traditional portfolio. If you were using Fidelity Wealth Management or even a robo-advisor like the SoFi robo-advisor, this type of asset would likely be excluded or capped at a tiny percentage. Why? Because the volatility is unmanageable for a long-term goal like retirement. However, for the active trader using a Fidelity trading platform or Interactive Brokers stock trading tools, this volatility is the product. The wide swings provide the opportunity. If you bought at 8 and sold at 80, You made a career's worth of returns in a day. If you bought at 80 and are holding now at 40, you are learning a very expensive lesson in chasing heat. I want to pause here and ask you a question because your perspective on this matters. Given the massive volatility and the hydrogen angle, I want to know, comment below if you think the hydrogen sector is actually viable for the next 5 years, or is it just another hype bubble like we have seen before? And if you are brave enough, tell me, did you buy AFJK yesterday and are you holding through this drop? The market movement today also highlights the role of regulatory halts. You may have noticed that AFJK has been halted multiple times for volatility. These LULD, or limit up, limit down halts, are circuit breakers designed to pause trading when a stock moves too fast in a short period. While they are intended to restore order in a panic scenario, they often increase anxiety. If you are stuck in a trade during a halt, you can't sell. You are trapped until the market reopens, and often it reopens significantly lower. This is the nuance of market structure that users of simple apps like Robinhood Cash Management